Welcome to The Explainer. Today, we are jumping right into the question that everyone in tech and finance is asking. Is this incredible surge in AI stocks a real, sustainable boom? Or is it just a massive bubble that's about to pop? Okay, so here's how we're going to tackle this. We'll set the stage for the debate, then we'll look at the echoes of past bubbles to see if this feels familiar. After that, we'll explore why this time might actually be different. We'll make it real with a deep dive into NVIDIA's unbelievable earnings, look at the risks hiding in plain sight, and then wrap it all up with a final takeaway. All right, first things first. Why are we even having this conversation? Let's dig into why this question is suddenly on every single investor's mind. This isn't just some niche conversation for Silicon Valley insiders anymore. The performance of AI stocks has been so completely off the charts that this bubble question has gone totally mainstream. It's one of the biggest debates in the entire market right now. And hey, you don't have to take my word for it. Just look at this. This is Google's search interest for the term AI bubble. See that huge spike? That tells you everything you need to know. This isn't just Wall Street chatter. This is a real concern for real people. Okay, so with that in mind, let's look at the argument for this being a bubble. And to do that, you pretty much always have to start by looking back at history. What are the patterns we're seeing today that feel, well, a little too familiar? I mean, history's just littered with these moments. Massive investments in new infrastructure that create a speculative frenzy. You had the canal mania in the 1790s, the railway bubble in the 1840s, and of course, the big one we all remember, the dot-com bubble. The real fear is that today's AI build-out is just the next chapter in the same old story. And the scale of the money flowing in is just mind-boggling. We're talking about spending on things like data centers, the physical backbone of AI, soaring past $1.2 trillion by 2029. That's growing at 21% every single year. When that much cash floods one sector, it's only natural to worry about a bubble. We're also seeing some of those classic red flags. Lots of regular folks jumping into trading, IPOs popping on day one. But here's the one that really gets people's attention. Margin debt. That's money people borrow to buy stocks. It shot up over 32% in just 6 months last year. And get this, a jump that steep has only happened twice before. Right before the dot-com crash in 2000 and right before the big drop in 2020. Yikes. And then there's this. The whole market is leaning heavily on just a handful of huge companies. The U.S. tech sector now makes up about 35% of the entire value of the U.S. stock market. That is an incredible amount of concentration. It's a sign that the market might be getting a little top-heavy. Okay, but what if this isn't just history repeating itself? Let's flip the coin and look at the very powerful argument that says, no, this time is different. This boom is being built on a foundation of solid rock. The key difference, really, is all about the fundamentals. Back in the dot-com bubble, you had companies with soaring stock prices but zero profits. Today's AI giants, they are profit machines. They're posting massive earnings, generating tons of cash, and their valuations, while high, are nothing like the insane levels we saw back then. And just look at the projected growth here. For 2025, the AI-heavy IT sector is expected to grow its earnings by over 20%. That is nearly double the growth rate for the rest of the market. So these companies aren't just growing, they are leaving everyone else in the dust. And just look at how much healthier these companies are financially. We're talking about incredible profit margins. Valuations are high, sure, but they're less than half of what they were at the peak of the dot-com craziness. And crucially, they're funding their own growth with their own cash, not by taking on mountains of risky debt. Their balance sheets are rock solid. To really bring this to life, let's zoom in on the company that is at the absolute epicenter of the AI boom, NVIDIA. Their recent earnings report wasn't just good, it was jaw-dropping. It perfectly tells the story of what's happening. NVIDIA's CEO, Jensen Huang, calls it a virtuous cycle. And what he means is that demand for AI creates more AI development, which in turn creates, you guessed it, even more demand. It's a loop that just keeps feeding itself and accelerating. So let's start with this number, a record $57 billion in revenue. And let me be clear, that's not for a year. That is for a single 3-month quarter. That number alone just puts the sheer scale of this boom into perspective. Now, here's where it gets really interesting. Of that $57 billion, more than $51 billion came from just one part of their business, the data center group. That's the division selling the powerhouse chips that are the engine for the entire AI revolution. And the growth, it's just as stunning. That all-important data center business grew its revenue by 66% compared to the year before. Think about that for a second. A $51 billion business that is still growing at 66%. That's not just growth. That is explosive, accelerating demand being turned directly into real money. Okay, so the profits are real. The growth is historic. But here's the thing. A structural boom is not the same as a risk-free ride. So let's talk about the significant risks that everybody needs to be keeping an eye on. One of the more complicated risks is this idea of circular financing. Here's how it works. Big tech company A gives millions to a little AI startup. That startup then immediately uses that exact same money to buy cloud services from big tech company A. See the loop? It can make sales look bigger than they really are and hide what the true organic demand is. And that's not the only thing. There are other big questions out there. Are we just in an arms race where companies are spending way too much on AI just because they're afraid of falling behind? What about actually making money? Millions of people use AI tools for free, but very few are actually paying for them. And critically, a lot of businesses still can't prove that their expensive AI projects are actually making them any money. All right, let's bring it all home. We've looked at both sides of the argument. So, what's the verdict? Is it a bubble or is it a boom? So here's the crucial takeaway. All the evidence right now points to this being a structural boom. It's driven by real, massive earnings, not just speculative hype. But the two most important words in that sentence are for now. And that really leaves us with the billion-dollar question for the future. Right now, the fundamentals are incredibly strong and the growth is historic. But here's a fact. No industry can grow at 66% forever. It's just not possible. So the real test isn't what's happening today. The real test is what happens to these sky-high stock prices when that incredible growth inevitably comes back down to earth.